Hello, and welcome back to another exciting episode of Accounting 2301 Financial Accounting with your host, Professor Naragon. We're going to start with Chapter 6 today, dealing with cash, fraud, and internal controls, as you can see up here. We're going to first really start with internal controls. We're going to lead into a little bit of that fraud system. And then finally, we're going to get with cash with the bank reconciliation. Fun stuff. I will tell you that. Awesome. So, starting off, what is the control system? Internal controls. Do consider of policies and procedures that we use to basically protect anything we own, so our assets. We need to ensure the reliable accounting so that we can get the investors that we need. Uphold any company policies that need to be done, that we've done in our mission statements, all that fun jazz, and promote efficient operations. So again, time is money for these companies. So we want to make sure everything's running smoothly. We don't have any hiccups. Nothing going on. So big thing with internal controls is a lot of handling fraud. Okay? So again, the big old bad boy act, the government SOX has come back out. If you've seen chapter 1 video, we mentioned it there too. So again, SOX came out a little bit early after the fall of a big company known as Enron. With Enron done, Sarbanes-Oxley Act came out to basically have auditors really know what's going on, how we have to do it, and also made sure that managers like CEOs and CFOs had to basically certify the accounting documents and sign off of them. So they're now liable for it because of this act. So we must really certify also the system of internal controls. So we got this nice little graphic, awesome graphic right here, that gives us some of the things that are basically principles of internal controls. Now, there's probably a little bit more out there, but these are the ones that we're going to just hit. So, some of the ways that we can use internal controls. One, it is supposed to reduce processing errors. Now, errors still happen, but it really is supposed to stop the human involvement a little bit. It's supposed to catch a lot of our errors. It doesn't catch them all, but like any technology, it can catch most of our errors. So it's supposed to reduce that. It's supposed to limit evidence of processing. Again, this is an efficient item right here. It's trying to actually truncate how long it takes us to process certain items. So if it's in manufacturing or even as a tax account, we're trying to limit the paperwork. So we're really trying to make it more efficient. The more efficient we can be, the less basically processing that's going to take and more opportunity for the fraud. It's supposed to increase e-commerce. With internal controls, you have to watch out for this. And with e-commerce, this is our society that's going on now. We're more becoming globalized and online. Where online you got a lot of hackers. So just like that movie Hackers, which is a good movie, you should check it out. Shameless product placement. Anyway, with increasing e-commerce, we get to deal with the online aspect with hackers. So internal controls is actually trying to prevent hacking happening, especially with big companies like Amazon and Walmart with Jet.com and all the other online websites, eBay, PayPal. Now, if you want to look at a good internal control, check out PayPal or any bank that actually processes online. It's hard to hack into one of those. So they have a really good internal control. Next one, going along to U, we have separation of duties. This is a big internal control thing. And again, I will tell you, you need to separate the duties of basically who's handling the money. Someone should only be writing checks, somebody should only be making deposits, somebody should only be recording in the books, and you have to basically separate them out. Again, big corporations are able to do this. Small business, like mom and pop stores, unfortunately they cannot, and it actually brings a little bit more fraud to them. So you can do a really good question here. Ask someone who they think fraud really happens the most. Is it big corporations or small businesses? And you're going to basically find out that small businesses have more fraud because they couldn't separate their duties. Okay, it's just not rarely basically spread by the news like big companies would be. So, and then we got the last part. This is mostly with auditing, but it's more extensive testing of records. Now, auditors, if you decide to go into auditing, this is one thing you're going to be doing. You're part of the process of internal controls. You have to test the records, make sure everything's good, make sure there's nothing that's material. But with programs that are coming out, they also do a lot of testing. Again, their job is to reduce processing errors. So with more testing, we help reduce the errors. Okay? So all these kind of work hand in hand with each other. Again, these are the basic principles. But again, there's limitations. So, as you can see, our big fraud triangle has come back out. So again, just a refresh with the triangle. The first thing that you're probably going to have is what humans tend to do. We tend to reason. So we're going to rationalize anything that we're going to do. We're going to try to come up with a reason why to do it. Or why should I do it? Why should I steal that money? Why should I embezzle? We're going to think of that. We're going to also have pressure coming to us. Again, most likely this is financial pressure. Like you have to pay a loan shark, or your bills are due. You're going to lose the house. So there's more pressure on you to rationalize the situation, to commit the fraud. And the last bit is always the third. It's having the opportunity. So as you can see, with small businesses, since there's no separation of duty, there's greater opportunity. Mostly with accountants, we have basically more opportunity than anybody else because we handle so much of the money. So it's easy for us to actually take some. But it's just dumb. I'll be honest. Do not commit fraud. Do not embezzle. I will tell you, that's not always the smartest thing to do. You're going to get arrested and you're going to go to jail. But with that, there are limitations to internal controls, not only with fraud, but again, human error. Sometimes there are people that are just negligent at it, so they or just don't care and they do whatever they want to, and that's going to break internal controls because one, they're not following protocol. There could be fatigue. In the tax side, in the first 4 months, you're going to be tired if you're on that route. But as humans, we do get tired. So if we're working multiple days, like 12 hours a day or something like that, and we don't get enough sleep, there's more opportunities for us to commit errors. Again, misjudgment and confusion, those basically go a little bit hand in hand. One, we basically misjudge some numbers, or we get confused and we just put them in the wrong spot. That does happen. Again, internal controls can only handle so much. Again, their job is to reduce errors. They can't catch them all. Okay? It's not like Pokemon. They will not catch them all. Alright. Again, the intent is to defeat I mean, if your intent is to defeat internal controls for personal gain, you're going to figure a way. I mean, we're the ones that basically started the internal controls. If we really want to commit fraud, we're going to find a way to work around it. Again, not always the greatest thing, but that's why we have internal controls on internal controls, just to try and catch these people. And the last limitation, again, this is part of the cost benefit, basically, principle that we had. So, oh man, I forgot how to say it now. But basically, our cost benefit, one that we learned in chapter 1, this is also here in internal controls. If the costs exceed whatever benefits they can help us basically stop on fraud, is also one of the limits. So we're going to also look at the cost. Again, if I'm only assuming that whatever internal controls I get are only going to save me maybe $5,000, but the cost of the security cameras and stuff like that is like almost $15,000. Again, the cost doesn't outweighs the benefits. So you're going to see that a couple of times. So when you question, it's like, why don't you have this? Why don't you have that? That will help you stop this fraud. They're going to say, it just costs too much for us. So since we're going into cash itself, we're going to get a little bit more in the internal controls when it goes with cash. So again, it's more about cash in the way that we protect. So internal controls again has 3 basic guidelines in how they basically have internal controls. 1, handling cash is separate from record keeping for cash. Again, separation of duties. You want to keep them separated. So I don't want someone handling cash also doing my record keeping. Again, they can basically say, well, this was the amount that we actually got, or this is the amount that we actually paid, but they're actually basically pocketing some of the extra stuff. Cash disbursements are made by check. Again, this gives you actual documentation of what happened to the cash. Again, nowadays that we're getting to more online, if you're doing PayPal and doing distribution by that, again, it's something in writing that actually shows the cash disbursement. And then cash receipts are promptly deposited in a bank. Here, we want to make sure a deposit is always made very quickly, very promptly, like clockwork. You usually see this a lot with big businesses, but of course they run to the bank at night, put the deposit bag in. If you ever worked in retail and actually became a closing manager, you get to write the deposit slip and all that stuff to document all the money. And of course, there's always cameras everywhere, another internal control, but they make sure you do deposit the money at a certain time, at a certain day. All that, it's basically work on a schedule. So, with this, let's get into a bit of cash. Different terms that we have that you will hear every now and then, especially in the professional world. The first one that you got is known as liquid assets. And these basically refer to a company's ability to pay for its near-term obligations. When you look at basically a balance sheet and at the assets, you're going to notice cash is always on top, and then it's followed by probably accounts receivable and inventory, and it goes down to a certain pattern. Again, fixed assets are usually closer to the bottom, and then something with long-term assets and basically amortization, finish it up with trademarks and stuff like that, non-tangible assets. The reason why we keep this like this on a balance sheet is because we put it as liquid assets. These are more ones that we can basically get rid of very quickly. So this is why they're called liquid. Cash runs very fast, very quick. We get it, we use it, we get it, we use it. Same thing with accounts receivable. Tends to be a little bit more liquid. Not as liquid as cash, but it can be. So the way that the balance sheet is set up by basically how much liquidity our asset is. How quickly can we get rid of it? So again, we'll get a little bit more with assets as we move on to chapter 7 and chapter 8. So here again, cash is basically anything that we count as currency or coins. It deals with amounts deposited in the bank, checking accounts or saving accounts, and of course include but not limited to customer checks, cashier's checks, certified checks. It has a checks next to it. It's most likely dealing with cash, and of course money orders. But again, any currency, so even cryptocurrency like Bitcoin or whatever the next one was going to be, that is considered cash. So again, cash is basically like that. So if we talk about it, again, that's all we're really defining. The next definition you see here is, of course, petty cash. Now, I will tell you this, if we're looking at a fraud standpoint, petty cash is probably one of the accounts that get the most fraud. Petty cash is small payments that are required just to basically do postage, courier fees, repairs, and supplies. They're only there for basically the small stuff. And usually whoever is running petty cash will get the receipt from whoever bought the little stuff, like donuts or something like that. Usually that doesn't happen. I will tell you that. Sometimes the employee will say, oh, I lost the receipt, or I'll get it back to you, and stuff like that. And they're just pocketing the money, because probably there's a lot more that they got, and they're just saying that, oh yeah, it cost all that. So, and basically, this one can basically nickel dime a business. It's not material, so most auditors aren't going to just go, let's do a big audit on petty cash. No, again, it's just a small account, but it does have a lot of fraud related to it. So if you're a small business and you have petty cash, always keep track of it. Just to keep you ready for audits and stuff like this, that's practice. Petty cash is a practice account to make sure you're aware of what's going on how the process works. So you want to keep that going. Last one, again, is cash equivalents. So these are short-term, highly liquid investments. So like I was mentioning with liquid assets, this is your accounts receivable, basically any small term loans. So again, they're readily convertible to a known cash amount. I can sell off my accounts receivable to a company very quickly. Same thing with small term loans, CDs, and stuff like that. Those are known as cash equivalents. So they want to be close to the maturity date and not sensitive to an interest rate change. So really with those, it's very close with small term investments and stuff like that, bonds and so forth. So usually within 3 months of their due date, usually satisfy this criteria. So purchase within 3 months. So basically the best one is US Treasury bills. They don't change their interest very much. You probably won't get anything. So it basically helps a little bit with that. So just know that it is really basically something that's really close to its maturity date. Okay. So next we have our goals of cash management. What do we want to do with cash? Basically, we want to make sure we make our payments when they're due. Again, for business have credit just like we do. So if we pay everything on time, it helps our credit in case we do need to make a loan or get credit, basically a line of credit from a bank. It's good to show that we always pay our bills on time. We want to keep a minimum level of cash necessary to operate. Again, basically, you want to make sure that you can pay everything. Pay the bills, pay your workers, all that fun jazz to keep things operating. Again, that's only keep the minimum. You can have a lot more, but you want to make sure you keep the minimum so you keep the lights on in the factory. Okay? So, basically, our effective cash management involves applying the following principles. 1. Encourage collections of receivables. Just like we did in chapter 4, where you notice that there was discounts if you paid early. We want to encourage that. So we do offer a lot more discounts to get the money in as quickly as possible. Sometimes you may need to delay a payment of a liability. This can happen when cash is a little bit down and you can work with your whoever you owe the bill to. Now, that doesn't mean you don't pay them. You still gotta pay them, but maybe they're lenient because you've done well on your cash management and you're basically waiting on the next big job. So, you know the money's coming in, you just need to delay it just a few days. Keep only necessary assets. This is a big issue, especially when we look at the tax side and you have Section 179 assets, which basically means you can purchase an asset for up to $500,000 and write it off as a deduction that whole year. If you're not wise, some companies will actually buy just unnecessary assets to get this deduction. Don't do that, because basically what's happening is that asset is going to sit and it's going to cost more money just for it sitting. So only get assets when they are needed. Plan your expenditures. You need to plan your expenses. You should know what's coming. Okay? This is all about budgeting. And again, you're going to learn some of that budgeting in 2302. It's going to be cool. Invest excess cash. Okay? One key thing with companies is they get some of these shareholders or owners that see the excess cash and they would take it and they're going to spend it and buy the big house and all that while the company's not growing. You want to invest excess cash into the company to continue it to grow, to make it better, to get the comparative advantage over your competition. So, big thing is, if you're going to run a small business, if you're deciding to do that, make sure at the beginning to at least keep investing the excess cash in to get the better stuff, okay, to make your business grow. So of course we get this nice little picture, another one that just basically shows what's going on and what documents we may see. So if the clerk brings up cash sales on the register, we're going to have basically it going to the sales department with the cash, a cash sheet that shows basically who we received the money from, the amount. So again, internal controls, and again you get the signature of that cash clerk. With that, then it goes to a register sheet that basically shows what happened with the register, so you can link up the cash sheet with the register. This comes from the supervisor. Supervisor actually reads all this registered data. So we get that, we compare the two, and we make sure that everything's kosher, they got the right amounts, nothing's missing, and then we prepare our deposit slips and journal entries. So this is almost like a little flow of a regular cash transaction at the end of the day. Okay? So another thing that we have that's a big internal control is known as the voucher system. Now, with technology, it's a lot easier, but back in the day, you had a lot of documents. I will tell you that. And we did have files for every single one. So, with this, and I'm going to tell you this, if you take a capstone class in if you're whenever you do, you're probably going to see a lot more paperwork, documentation. But basically, our job in a voucher system is verifying, approving, and recording. So we're going to look at what's going on. We're going to follow the path. We're going to issue out checks once we verified everything. So again, you're going to see documentation known as source documents. That's going to have basically the same number running through. We just end up verifying it. So like this graphic shows, first thing is the request from the purchasing department. We end up going to purchases and accounting. So whichever department decides to make a purchase, the purchasing department then creates a purchasing order. We verify it with the supplier requesting, receiving, and accounting. So accounting, again, we get all these documents that basically say this is good, this matches up to our purchase request. The supplier will then send an invoice. Of course, as accountants, we again make sure the invoice matches the purchase order so that we don't see anything extra, like extra inventory or different cost than what we actually purchased. Then the receiving department receives their report. So when the inventory hits our shipping or mail place, wherever, again, we double check. We're vouchering each one. We verify and make sure everything is there. Okay? And then we get the invoice approval from the accounting department. We said everything's kosher. You're good to go. And everything was over there. There was no added cost, nothing there. So once that's approved, it goes to the cashier. From the cashier, we finally get to write off the check to the supplier. So again, there's a lot of steps in this process. Technology has basically started to basically truncate this a little bit more, so it's a lot quicker. Again, it's reducing that processing. Okay, just trying to reduce that so that basically it's more streamlined. So now we're going to get to the big bad boy of chapter 6, and that is internal controls provided by the bank to protect cash. Okay, so we'll get into the bank reconciliation. So different ways that a bank can help you out, because again, banks are trying to stop fraud as much as they can. They can't stop everything. Debit cards do get leaked out. People basically get their card taken at the gas station. There's ways a person's going to fraud you, but they help as much as they can in preventing that for everyone and even businesses. So you're going to have end up one is signature cards. So with the signature card, basically anybody that has access to the bank account for a business or a nonprofit will actually have to put their signature on record for the bank, so that when they actually receive anything that's signed, they can match it up. They're actually supposed to match up your signature on the card to a signature on a check or deposits or anything else to make sure that's correct. Next, we got deposit tickets. So with deposit tickets, again, these are the deposit slips. A bank is going to verify whatever's in the envelope, the package, that the cash is correct with the deposit ticket. That it's not more, it's not less. And if it does have an error, they're going to immediately contact whoever the business is, whoever's on the signature cards, to say something's not right. Of course, we got bank statements themselves. This is, of course, a verification tool on your part to make sure everything is right with the cash account. They provide this, which shows every transaction that happened in a certain period. We got electronic funds transfer, or basically EFTs, if you ever saw those bank statements. Again, that's like paying something online. Okay, so automatic transfers, all that. those are going to be highly looked at with banks. More than anything else, because again, if your card gets cloned and somebody using it in a way different city than you're from, they're going to see these EFTs happening, and they're going to run and see if that's true. If it doesn't look right, then they may actually have to give you a call saying, hey, we've noticed this amount. We may want to actually check into it. Okay. Checks, of course, again, same thing with signature cards. The checks are going to have your signature on it, and they're going to verify all this. Again, physical documentation is very key, so they can actually pull this up in case of an investigation and to actually show the check, when it was written, the date, amount, everything. And then lastly, of course, their own bank accounts. I mean, again, bank statements and bank accounts both go on the same hand, but bank accounts, they basically put a lock and key on, especially with businesses. So they're going to try to stop as much fraud as possible in these bank accounts. Again, this is when you hear the calls from the actual bank saying something doesn't look right. Did you do this? They're going to verify a lot on this. Okay? So this is going to lead us to basically the big bad boy, the bank reconciliation itself. With the bank reconciliation, you're going to notice a few items. And I will tell you this, while I'm going through this, I would say take your own personal bank account and bank statements and do verification. It will help you out as much as possible, because again, fraud does happen. Bank can't catch them all, and I will tell you this already, people are getting smarter. There's ways to clone where you're at and to show that these transactions are happening in the same city, but now it's not for big, basically, purchases. They're going to start nickel and dime your account. So $5 here, $10 here, and they're going to do it at places you normally shop at. So Walmarts, HEBs, grocery stores, whatnot. And the thing is, they're just to try to make you believe that you actually did go to these places, you just forgot. So you always want to keep a check. Anything that's questionable, you can always go, hey, I don't remember this. Let's try and go back through it. See that? And bank reconciliations actually help. So with the bank reconciliation, you're going to notice the basic stuff. First is always the company name and address. You're going to have the date. Basically, it's going to be the end day of whatever month or whatever cycle that the bank statements follow. And also your account number. Again, if you're in bookkeeping, that's a very sensitive item, and you need to have your own internal controls to make sure their bank accounts do not go out. I mean, it sounds like common sense, but it does happen, so you will need to keep that in secrecy. Okay? Then, just like your cash account on a business, you're going to have a beginning balance. You're going to have all the checks and debits. So all this is basically your credits that happen. So again, this is my cash going down. This is my cash going up as deposit. Notice this, with the bank, they do exactly the opposite of what we do on the books. Notice deposits are credits to the bank. This is the reason why, because the bank owes you that money. You made a deposit in your account, well, in case something happens, the bank has to know to actually pay you that amount. For us, that's a debit, because that's our way of going. Our asset increases. Their liability to pay out your asset increases, so it's a liability to the bank. While checks, basically, the bank takes money from you. It's their cash, so their assets increase when a check happens. So it's a debit to the bank. Okay? So remember, when we're dealing with debits and credits, these for the bank are exactly the opposite than what we usually use. Okay? Book does it opposite. Just want to make sure you don't get confused there. So again, deposits make our cash account go up. So they're going to find the current balance right here. Should be the ending balance in sort of pseudo cash. Okay? They're going to be very similar, but there's going to be some items that are not there yet. Okay? So our job is to make sure our bank balances our cash account on our business. And of course, this lists all the deposits and all the checks. So we're going to be looking at these, seeing if there's something that's missing between our books and our actual bank. And there's going to be stuff missing. And of course, there's a legend in case there's actually stuff that needs to be known that you don't know. Alright. So, with that, here's our little graphic for bank reconciliation. Now, this is something that's usually done at the end of each period, basically because we can't do anything until we get the bank statement itself. So, with this, we take the bank statement, we're going to take the bank balance, we're going to add and deduct any timing differences, any errors. Again, we're going to get a little bit more involved with this in just a sec. And then we also do the same thing with the book balance. Okay, so it looks a little complicated. It's really not. We're going to get into more of a step-by-step. But again, you're going to notice this. Here's the note. Whenever we're doing the bank reconciliation, it is very, very, very rarely that our checking account is going to equal our balance in the books. There's always going to be some timing differences, and there's always an opportunity for human error. So with this, we're going to look at the equation for bank reconciliation. First, we start with, again, the balance per the bank, what they're saying our cash should be, the balance per our books, where we say our cash should be. So we're going either with what we're saying and we're comparing to what the bank says. And you're going to have to add a few items. So again, one thing we're going to add is deposits in transit to the bank's balance. These are deposits that are happening at basically the end of the period that have yet to show up on the bank statement, but they have shown up on our books. So we need to add those to the bank balance. Likewise, there's going to be checks that are going out at the end of the month. Some of those checks do not show up. They may be from other periods. People just haven't cashed them yet. So anything that's outstanding, checks that we know that we actually issued out, we need to subtract that from our cash balance. And then of course we need to either add or subtract any errors that the bank has made that we have found. This is going to be our adjusted cash balance. On the flip side, to our cash balance per book, we must add on any collections that the bank did for us. Sometimes they will do that. They will help us out with getting accounts receivable or any loans. We also need to add any interest. Again, we're not going to know the interest till the bank statement shows up. So when the interest shows up, we add that to our balance per our book. Then we subtract out any uncollectible items, mostly fees, stuff like that. Then we add or subtract any errors also on our end. And then we have the adjusted cash balance. And these two must balance. If they don't balance, that means we need to check to see if there's any more items that we either need to add or subtract. Alright, so there's really 9 steps involved into the process of doing a bank reconciliation. Again, this is just the steps involved. We actually have a pretty graphic that goes through it all. So just in words, it's the same thing I just told you upstairs in the graphic above it. First thing, we identify the bank statement balance of cash account. So this is our balance per bank. We find and list any unrecorded deposits and any bank errors understating the bank balance. So basically, if it's subtracting from the bank balance, but bank balance is supposed to be higher, these are ones that we add in, these kind of errors. And we add them to the bank balance. Then we identify the outstanding checks, any bank errors that happen to overstate the balance that the cash is supposed to be, subtract those from the bank balance, and we compute our adjusted bank balance. And watch out, they do call these other items, like the corrected bank balance or the reconciled bank balance or balance per book or bank. Step 5, 6, and 7, as you can see, are basically the same stuff that we did with the bank, except on the book side. Again, we compute. And then the last step is to verify that the two adjusted balances are equal. Again, if they're not equal, we need to go double check. Again, check for missing data, anything that we just happen to miss. Believe me, this could take a long time, especially since accountants, we do need to calculate to the very penny. So if we're off by a penny, we're definitely going to be double checking everything to find that one penny. It happens, but we don't want to be out of balance. Okay, so these are the 9 steps. Again, this is how we go. So I'm going to go through the 9 steps using the graphic here. So again, first step was the bank statement balance. This is what the bank showed me. And skipping over here just so you can see the difference, book balance is, of course, is something different. So during this process, we found out that a deposit that we decided to make on October 31st to the bank has not showed up on the bank statement. I wonder why. You can't expect it to be on the same day that the statement's issued. So with this, we have to add it to the bank due to it being basically, it will increase the money in our bank, but it's in transit. Next, we have our outstanding checks. So these are checks that are basically flowing out that we know that are part of our book balance, but haven't yet been cashed through our bank. So we must subtract those out. Here we have been to have 2 checks, number 124 and number 126. So add them up, and we find out that we have 350 that we must subtract out. This is money that's later going out eventually. So our bank balance should be actually $1,845 in cash. On the other side, on our book, again, we'll start with our ending balance in our cash account on our book. So again, this is the ending balance on the bank statement. This is what they're saying that we should have. Here our book has a little bit different. 1, we find out that the bank actually collected $500 on a note. But of course they took their 15 fee for doing our job for us, so we gladly pay them a $15 fee if we got 500 bucks. It works out. So we actually have 485 that will increase our book balance that we didn't know that they actually collected, but it's okay. And of course, interest earned. Again, interest earned happens at the end of the period. We won't know this until we get that bank statement. So Add those two together, gives us $493 that we add to our book balance. Next, we take out basically any kind of fees that end up happening. One is common. We probably have a check printing charge when we order checks. So we'll have that fee. And then also another fee that tends to happen a lot is NSF Check plus whatever service fee. This one's $30. But again, NSF just means non-sufficient funds. And that does happen time to time when we deal with companies or deal with customers. They write us basically a hot check, and when we try to deposit it, it doesn't clear. But in our books, we still thought it cleared. Here it did not. Probably happened closer to the end of the month again. So we basically have to pay the bank, again, that amount plus whatever the fee is. So this is a total of $53. Notice when we subtract 1,898 by 53, we get 1,845. Balances must equal. Seriously, they must equal. So if they're not equaling, again, verifying, we must make sure that they do equal. Okay? With our journal entries, because you're going to have to make journal entries. Again, when we do a bank reconciliation, this will only affect the book side. We are not going to change the bank. We don't own the bank. We don't have to change anything with the bank. The bank's going to eventually process them out as normal. But the book has to fix whatever items that we didn't have in it in the first place. So our goal is to get to this balance. This is why we do the journal entries. Okay. So again, we're going to go through each one that actually shows up here. So the first one was the credit memo right here. And we show that the bank collected that $500. Paying on October 23rd minus the $15 collection fee. So with that, we're going to make this type of journal entry. First journal entry, again, you're going to notice all these are going to be dated on October 31st or at the end of the month. Again, we don't know about these until the bank actually gives us the statement and we reconcile. So that's when we date all the journal entries. Again, it just shows that we made the journal entry at the end of the month to reconcile. So with this, first we record the cash. 500 minus the 15 is the 485, which if we did the bank reconciliation, there's the cash statement right there. Again, since we're adding cash, we received cash. Again, that's another way to know that we have to add it to our book balance or make it a debit. We have now collection expenses. This happens again when an expense is collected, and it's good old $15. And usually it's a note receivable. Again, small term loans that we've issued out to people that we expect to get interest and stuff like that. Those are the ones that are going to have mostly the bank is going to collect on for us. So this, we need to credit that receivable because no longer they owe us that $500. Again, we lose a little bit of money due to the expense, but hey, again, it outweighs the actual money received. Okay? And the bank will only do this if we actually tell the bank to do it, to just say, hey, make sure you collect this for us, we accept the fees, so forth and so on. Because the bank wants to make money. Again, bank's a business and wants to make money. Okay. So the next one, the next increase we had was for interest. So when we do interest, again, we're going to have cash increases because we received money, the good old glorious $8, and we have to record it as interest revenue. This is the amount that has been earned. This is also known as an other income account because it's not part of our everyday business, but it's still money we have earned. So we have to have interest revenue. The adjustment 3, because again, you just go down the list. Next one is the check printing charge. So with this one's going to mostly land into miscellaneous expenses. Again, it's just a small fee. We're not going to go too much big into it. So it's just a miscellaneous expense for basically purchasing more checks. Okay? So miscellaneous expense gets 23 bucks. Cash is going out to pay for this. So again, $23. Okay? And the last one is the NSF check. Okay? So the scenario basically again is the bank statement showed an NSF check for 20 bucks. It has a related $10 processing fee, basically saying that they had to return the check, and then they basically $10 fee for the work that was involved in to try and make that check deposited. Again, always check your fees when you open up a bank account so you know what happens when this happens. Well, of course, we're upset that we had to pay this amount, but we're going to charge whoever customer that is. So you're going to see this account actually happen. We're going to debit accounts receivable for that full amount, not the 20, and there is no fee. So you do not separate these two. Do not separate even though it says processing fee. This is one transaction. We're going to make sure the customer knows that their check got bounced and now they owe us the check amount plus the processing fee. So again, this is the check amount plus processing. That goes to accounts receivable. And again, cash had to go out to basically pay for this that we thought we had. So cash gets credited by 30 bucks. Again, if you have troubles with these journal entries, just let me know and I'll make sure to answer any questions that you have. Leave them in the comments or send an email and we'll make sure we get you to understand this. Okay? Last little bit, we get days sales uncollected. Again, this indicates how much time is likely to pass before we receive cash receipts from a credit sale. So we really want to make sure we get our accounts receivable paid, and we don't want them to be sitting for long. Again, the longer they sit or the longer they are uncollectible, the more likely they won't be collected. So we always want to make sure we got a high turnover rate. So many days, especially it does look like for investors, if we can collect them very quick, means we can basically turn them liquid and start investing the cash. So again, we have our example. We got two companies that we should know in Hasbro Mantel. And again, we take the accounts receivable, divide it by net sales, and then times it by 365. As you can see, it takes Hasbro a longer time to actually collect their money. Every year it takes a little bit longer. But notice with Mantel, they try to shorten it up. So as you can see, there was a drop down till 2015, but they're trying to collect quicker. They may be adding more discounts, all that stuff. Again, it's just basically good for investors to see how quickly you are collecting your accounts receivable. So how long are they sitting? So with this, of course, we have a practice problem. Again, we're going to go through 6 steps, what they are, how we see them, and how we do a bank reconciliation. We even have journal entries related to them. Okay? So, with this, I do know this is not showing up completely. So, that does bite a little bit. Maybe if I zoom this up. Alright. There we go. Alright, so with this practice problem, again, you need to have your header. Sometimes the header's not there. Always remember, it's the first one is the company, second is what statement we're doing, and third is the date. Again, the date's going to be the ending, whatever period we have, ending month, because basically it's, again, something related to the balance sheet. So, the following information is available to reconcile Gucci. Okay, so Gucci bank balance of cash with its bank statement as of December 31st. So you're going to see problems like this on your homework. You do want to basically, I would say, suggest again to print out. It's always good to highlight just because it's a lot of words. Again, you're not going to see an actual true bank statement and a pair of books, a general ledger on that. We're going to basically combine the two and these words. So we need to read each one. So A, the December 31st cash balance according to account records is $1,610, and the bank statement cash balance for that date is $1,900. Okay, so again, we want to highlight anything that we can here. Unfortunately, this is all just one big graph, so it's not going to let me highlight as we go. But I would suggest to always highlight. So, first thing is we have, let me click off of that. Thank you. Whatever. Alright, first thing you have is the 1,610. Notice it's related to our accounting records. And then we find out the bank statement cash balance says it's supposed to be 1,900. So when we look here, we're going to add the 1,900 to the bank statement balance, and of course the 1,610 to the book balance. Those are the amounts that we start off with. We always have to start off with a certain amount. Next thing, part B. Let's see what's happening. On Gucci, December 31st, daily cash receipts of $800 were placed in the bank nightly depository on December 31st, but do not appear on the December 31st bank statement. Again, of course, if you deposit on the day that the statement's supposed to come out, they're never going to show. But because it was still done on December, or in that month period, according to our books, we need to increase our bank statement. Again, we already know we had cash receipts. They were placed in the bank, and they did not appear on the bank statement. So since they did not appear, this is known as the deposit in transit, or deposit of December 31st, or on December 31st. However you want to write that, make sure that you do correct that deposit, something that we didn't see, but on the book balance. Next one is C, check number 6273 for 400, okay, and check number 6282 for 100 were both written and entered into the accounting records in December. So they're in our books, and they are not among the canceled checks. So again, when the bank processes a check, they basically cancel it out. It's no good anymore. So these two checks are still floating around. Because of that, these are known as outstanding checks. So you're going to put these in our deduction, and there they are. So make sure you have the check number. Again, traceability. We want to know that if anybody looks at this bank's reconciliation, they can immediately trace it to what's missing. So of course we have the 400 and the 100 with the right check numbers. Next one, we keep looking. We didn't finish, that was only the first sentence. So next sentence, we have two checks. number 6231 for 2,000 and number 6242 for 200. Both were outstanding in the most recent month of November 30th. So both of these checks were not part of the canceled checks at the end of November. Let's see if anyone processed during this month of December. We found out that check number 6231 is listed with December canceled checks. So 6231 has been cleared, but 6242 has not. So someone still is waiting over a month to actually cash this check. Will it ever be cashed? We don't know. But because it's still floating, we have to carry that forward. So some businesses, you will see them just keep forwarding checks that are still floating around, because no matter how old they are, they can eventually be cashed and affect our cash balance. And we always want to be prepared and track this. Sometimes we just have to reissue the check. So like IRS, if you already done your tax return, got the refund, but forgot to process the check, or basically cash your refund check, eventually the IRS is going to reissue a refund check to say, hey, you haven't cashed your first one, here's the new one, maybe you lost it. So businesses do the same thing. They're going to wait a certain time period. If it's something important, they're going to reissue the check to make sure. Of course, when they reissue a new check, they're going to void out the old one. But with this, now all we have to do is the adjusted bank balance. Again, doing our steps. So we have the beginning, we add the 800, and we're going to subtract out 400, 100, and 200. So with that, our adjusted bank balance should be about $2,000. Now let's look on the flip side. Okay, because it looks like we're all done there. We finished that. Right? So D, when the December checks are compared with entries in the account records, it is found that check number 6267 has been correctly drawn for $340 to pay for office supplies, but was erroneously entered in the accounting records as $430. Okay, so we had a couple of transposed numbers here. Basically, the numbers got switched. So with this, look at what's going on. Okay, so the bank correctly drawn it. When it says correctly drawn, that means the bank actually pulled out the money. They pulled out $340, but we put the expense, or basically credit our cash, by $430. So first we need to take the difference, and the difference between these looks like about 90 bucks. Well, if cash got drawn too much, we need to bring it down to this $340, which means basically we need to add back that money, add back the expense. So we're going to add the error in that check. Okay, it's 90 bucks. Check difference. I will tell you this, the hardest part of bank reconciliation is the errors. Mostly we have the journal entries, but just look at what's going on. Again, office supplies should have been $340. It was actually rented for $430. So again, the amount that we have on the books is higher than what actually cleared. So office expense is a debit account. We're going to have to credit the account to get back down to $340. So basically the cash that we thought we pulled out, we didn't. So we should actually have more cash. Okay. Again, those are going to be the ones that you have to watch out for, are the error accounts. Okay. E, a credit memo indicates that the bank collected $500 cash on a note receivable for the company, deducted $30 collection fee, and collected the balance to the company's cash account. Gucci did not record this transaction before receiving the statement. So again, this is a bank collection. we're going to have the total amount as the $500 minus the $30 fee. Again, we're going to write it as a collection. I will tell you this, easiest thing to do is always do it precedes of what kind of note. It's always going to be a note receivable, and put it in here in the description less that $30 fee. Reason why, because again, we actually have to make those collection fees an actual account. So this lets me know there's 3 accounts involved in this one transaction. Okay. Alright. F has 2 debit memos, are basically bank fees that end up happening, which are unrecorded at the time of reconciliation. One happens to be a debt memo for $150. This is dealt with an NSF check of $140 plus $10 fee, and it came from Prada, which is kind of weird. Prada and Gucci, so the purses are not paying each other. Anyway, so with this, when I see this going on, again, these 2 amounts that are combined that create the 150. So this is an NSF check of $150. The next demo, the second debit memo that we have is a $20 charge for check printing. Gucci has not recorded any transactions. Normally, if they're up here, you definitely know they haven't. So again, we're just trying to get you the basic knowledge of what bank reconciliation is, and we need to enter the printing fee. Notice that there's a blank here. That does not mean we need to put a number here. The only reason why the blank is here is that there's 3 items to deduct on the bank side. There's only 2 items to deduct on the book side. And again, we're going to do the same thing. We're going to take the book ending balance, add items that we found that increase our cash, like the error and the proceeds from the note, subtract out any fees, and we come out again to $2,000. So as you can see, they match, everything's good, we're all happy. We can move on to the next part, which again is creating journal entries. Again, the journal entries are only going to be on the book balance, okay, the book side. So we're going to take them one by one. So the first one should be the error that happened, the $90. So again, when we have these errors, let me scoot this up. Okay, so when we have these kind of errors, first we need to see what account it was, and it's basically going to be an adjustment account. Again, this is the only time we adjust cash is during a bank reconciliation that shows an error of cash. So cash is going up. Again, it's a debit, $90. We credit whatever account, expense account that was supposed to be. This happens to be office supplies. Again, it could be any expense account that we accidentally do a switch of numbers. Usually those are the typical errors that you see. Again, since we know we're adding the amount because we balanced, again, if these weren't balanced, if you put the error down here, they will not balance. So that will tell you need it fixed. But notice this. Easy way to know where cash is going on the journal entries is that we already know cash increases by debit, decreases by credit. Or here, we already told it that we're going to add these amounts. So those are our cash. Cash is increasing. So that's our debits in these journal entries. And then here's our credits. So with that, we already know where the cash account lies. We just have to find out the other accounts. So next one, collection of notes. Again, we already know our cash. Our cash was the $470 that we already shown up here. Again, the reason why I tell you to put this less the $30 fee, it automatically tells you that there's another account that we have to take the 30 bucks. Because again, cash does not receive to the notes receivable. Because in reality, we did receive $500. Now, if you want to put $500 note less $30 fee, you can do that. As long as it helps you remind you that, hey, we need to do these 3 accounts. Okay? So again, we received $500 on that note. Bank took out their money from the cash we would have received as the collection expense, and we received the rest in cash. Next, we have the NSF fee and the printing. So again, with the NSF, a whole amount goes to account receivable. Do not look up at this transaction and try and separate these. Again, it tells you right there that the whole memo was $150. Even if it doesn't, again, do not separate those two. The customer product owes us that $10 extra fee now, because that was part of their check that they wrote to us. So they now owe us $150. But we had to pay out that cash. Last one is the printing fee. Again, that's the miscellaneous expense. So on December 1st, we have the miscellaneous expense of $20, and the cash goes out for $20. Okay? So that's it for chapter 6. I'll see you in the next video. Make sure again, if you have any questions, you're more than welcome to leave them in the comments below. I will answer them as soon as I see them, and we'll get you going to make sure you learn a little bit more about the reconciliation process and how things work with internal controls. So, as we conclude this channel, this show for today, I will see you at the same bat channel at the same accounting time. I will see you later in the next exciting video of Accounting 2301. Okay, y'all guys have a good one.